Are you waiting for rates to fall back into the 5% range or just get lower than where they are now before you buy a home, refinance, or look at consolidating your debt? If that's you, you are not alone. It is a lot of conversations I am having recently. And while I don't have a crystal ball, I do have access to historical information that can help shine a light on what is the best next step to take. Mortgage rates can improve, but it's hardly ever happening in a straight line. And even the Fed decreasing their rates doesn't automatically mean that mortgage rates are going to improve. In this video, we're going to examine the last 2 years of the U.S. 10-year Treasury. And while it is not a direct correlation to mortgage rates, it's definitely a benchmark that's pretty important and influences them. So let's dive into it. So let's start in September of 2024. We can see here that the 10-year was right around 3.6. And that was the lowest point that we can see is being shown on this chart. Someone looking at the downward trend at that time might have assumed that rates would have kept falling in this range, but that's not what happened. Over the next several months and throughout the election, we can see here that the yield climbed from approximately 3.6 all the way up to 4.8%. So in other words, the market moved in the opposite direction than what many people had been expecting at that point. And that matters because it demonstrates how quickly a perceived opportunity can completely disappear. Now here in January 2025, you can see in this entire 2-year period, this is the highest point. Now it began moving lower, but then look closely at what happened. It's not falling in a straight line. It's taking these jumps. Then you can see things started to improve and move lower. But if you look closely, you can see that it didn't happen in a straight line. There were several temporary declines followed by some rebounds. The yield fell, moved back up, declined again, moved back up, declined again. And then you can see it took about 9 months from January to September to go from the highs of 4.8 to about 3.9% on the 10-year Treasury. And this decline wasn't even permanent. After reaching the lower range in the fall, the yields began to move higher. It approached about 4.3%. And then briefly declined near the beginning of 2026. And that's where we saw this improvement from January into February in the new year. And again, we all assumed it was going to just continue improving. And then uncertainty with the conflict overseas. So that's geopolitical uncertainty. That then causes oil prices to increase, which then creates inflation concerns. And that, in addition to economic data and investor expectations, has created a situation where we now have had an upward trend since February. So now here we are in July, and we are back towards the upper end of the 2-year range of where we were in December of 2025. So here's the lesson that we've learned. A temporary improvement doesn't necessarily equate to a long-term trend downward. The Fed directly controls short-term rate policies. So those are things like credit cards, home equity lines of credit, and auto loans. But mortgage rates are influenced not only by what's happening in the bond market and with the 10-year Treasury, but also with the economy. So what's happening with inflation, the job market, economic growth, and then also investor expectations. That said, it's very possible that mortgage rates can improve after a Fed decision, if that's what the market was expecting, or they can worsen after a Fed decision if it's going against what the market was expecting, or based on the comments of what the Fed is saying that is going to impact their expectations of future economic health in regard to inflation and the job market and the economy strength as a whole. Now, I'm not saying that mortgage rates are never going to come down. They will. We just don't have a crystal ball of when. They are going to rise and fall. They are going to likely stay in a tight range like they have been. It's just that in the short term, especially since 2020, we had a steep decline in rates. And then after that period of time, we had a sharp increase in rates. And it's like we're just waiting for that next thing to happen, for that next sharp improvement to happen. And history has been showing us that's not what's going to happen. So while rates are going to continue to rise and fall, there will be periods of meaningful improvements that are definitely possible. It's just challenging to predict them. But if your financial plan is completely dependent on rates suddenly falling 1 or 2 percentage points, they're not really working from a plan. Dare I say, you're making a market prediction, and the charts are showing us how unreliable those predictions can be. So instead of asking, when will the rates finally drop? Consider asking, what is a comfortable payment that I can afford? Would buying now solve a housing need that you have and help you with building equity? Ask yourself, how much equity, money, could I make by simply just making a mortgage payment? If you're already a homeowner, you can ask yourself if refinancing and using the equity that you have built up over the last few years, if that can help improve your monthly cash flow enough to help justify the current rate and the closing costs that you would pay for a loan. We live in the monthly payments that we pay, not the interest rates associated with them. And those decisions that you have to make, you can evaluate those with real numbers. Now, this doesn't mean that everyone should buy or refinance immediately. The numbers still need to make sense. And a refinance should be evaluated based on the closing costs, the monthly savings, the break-even period, the expected time that you're going to be in the home, and your larger financial goals. And your home purchase should be based on what you can comfortably afford and your readiness, not the fear of missing out. So my takeaway is simple. Mortgage rates may improve, but the last 2 years show us that the improvement can be slow, uneven, and easily reversed. So don't put your goals on hold solely for the hope of a dramatic rate drop. If waiting still makes sense after we review the numbers, then at least you can wait with strategy. But if today's options already improve your situation, then waiting for a perfect rate could only cost you more than it actually saves. My name is Amber Jones. I'm a certified mortgage advisor, and I'm here to help inform you, empower you, and help you solve that financial obstacle that you're currently facing wherever you're at on your home ownership journey. I would love to have a 15-minute free consultation conversation with you to help go over your questions, concerns, and help you plan the next steps to meet your goals. You can use the links below to book a call with me. Hope you found this information helpful. Remember to like, subscribe, and share this with a friend. Hope you have an amazing rest of your day, and I'll see you next time. Bye-bye.